Welcome to our Twitter Spaces with Bluejay. We do this on a weekly basis where we bring on various protocols in different fields so that our listeners can learn more about the DeFi space in every corner, in every sector. And today we have Carapace, Ty, and Rohit, who just recently raised 2.5 million and are building in the real asset lending space, specifically on providing credit default protection for under-collateralized loans. And thanks again, Ty and Rohit, for the opportunity to speak with you. And let's get this started. And if you don't mind, just briefly introduce to us what Carapace is, and introduce yourselves as well.
Sure. Let me start from my brief intro. I'm Ty, co-founder of Carapace. I've been involved in the blockchain space since 2013. Time flies. First, I was exploring various topics such as game theory, computer science, and cryptography by following my curiosity. But when Ethereum came out, I started to build stuff on top of the blockchain. So I built a Solidity open source library, an NFT game, options aggregator, a mobile wallet, etc., etc. And last year, I came up with this idea to build credit protection protocol for under-collateralized loans, which is Carapace. So let me hand over to Rohit, and then we can talk about Carapace after that.
Hey guys, Rohit here. So I'm the other co-founder of Carapace. I come from a traditional finance background, and so I started my career in New Zealand with a bank called ANZ, and was in the corporate finance team. After about 3-4 years there, ended up back in India. That's where I was born. And after a few stints, including political consultancy, as well as my own startup, I ended up working for Uber at a pretty early stage for them in the country. And after a year there, moved to SF with them, was working out of HQ in ops and financial partnership roles. And after 5 years there, decided to join an idea accelerator called South Park Commons. That's where I came across Ty. That's also around the time I was getting really interested into crypto and the power of blockchain technology to revolutionize the way we currently produce and consume financial services. And that's some of the ethos which brought me to Ty, and we decided to work on this together. So with that, let Ty take you through his thought process and how he decided to start Carapace, and I can chime in on my thoughts as well.
Yeah, should I give you a brief overview first? Or do
sure.
You want...
Sure, go ahead.
So Carapace is an on-chain marketplace where traders can buy and sell credit default protection. For example, imagine you lend some money in under-collateralized lending protocols like Goldfinch, and since the loan is under-collateralized, the chance of default is higher than protocols like Aave and Compound, where loans are over-collateralized. So you might want to, as a lender, default risk. And in order to do that, you pay some premium to Carapace protocol. And then you can get the right claim a payout when the underlying loan actually defaults. And since this is a marketplace, in the other side of the market, we have sellers of protection. So if you want to earn yields, then you can deposit capital so that you can earn premium the buyer has paid to Carapace protocol.
Nice. Yeah, is it very much like an insurance protocol? If you guys know any of those.
Yeah, it's quite similar. We don't consider ourselves insurance. In traditional finance, it's called credit default swaps. So it's more like swaps.
Yeah, understood. And if you guys don't mind to elaborate further on what were you guys doing prior to Carapace, and how did any of that experience inform you of entering crypto and working on a product for credit default protection on chain?
Yeah, I can go first. I made Bitcoin around 2013. So I've been just fascinated with technology for some time. And before Carapace, I was building a DeFi mobile wallet, but I had to shut it down. So after that, I was exploring some ideas in DeFi protocols. So I built on an options aggregator volatility protocol. And one of the ideas was Carapace. And at the time, I was witnessing the emergence and the growth of under-collateralized protocols like Goldfinch, TrueFi, Maple Finance. And I also discovered that there is no reliable way to hedge against default risk. That's why I thought, oh, this is missing in the market. Maybe we should build it.
Yeah. And to add to that, where I came from is I had worked at a bank before for 3-4 years, one of the largest banks in New Zealand. I had experienced financial services in New Zealand to start with as a consumer, and as someone who was working at a bank, also in India as a consumer, and the US. So I could see like various types of inefficiencies in all three systems, and also how disparate all three systems were. How even though you had technology in some places, it wasn't disseminated in the right ways, or there weren't the right incentive mechanisms in place to enable adoption of that technology. And so I got pretty enamored with blockchain services, and especially some of the work that under-collateralized lending protocols like Maple and Goldfinch has started to do, because it wasn't just games, it wasn't just gimmicks, it wasn't just made-up yields. It was like something sustainable that helps the real world. That's what got me really attracted to the space. And like Ty, when Ty talked through his idea, I was pretty convinced that you'd need other support primitives, other basic building blocks to also be built alongside these protocols. And I believe what we're doing is going to add to the ecosystem and help build a stronger ecosystem. I wrote a few of my thoughts about the fallout of FTX and what that meant for under-collateralized lending. I think for us to avoid getting impacted to the degree that we did with events like FTX, we need to build better support systems and protocols. There's many protocols doing that. We're one of them. There's many other protocols doing that as well. So overall, pretty enamored by the space and have strong conviction in the fact that you'll need other support mechanisms coming together to help the industry.
Yeah, I totally agree. The under-collateralized lending space is still very young, and what you guys are building is a key infrastructure necessary for the space, especially in the area to develop further and expand. Yeah, and actually, just a side question out of my own curiosity. What's a day in the life of the founders of Carapace look like for Rohit and Ty? What roles do you guys play? What's your day-to-day operations like?
Yeah, I think, I don't know if this is going to be interesting. It doesn't look as interesting as a day in the life of a YouTuber, I think, because they usually show only the glorious part of their life. But yeah, I try to figure out the most important and challenging problems that I need to solve every day and just work on. And at Carapace, I consider myself a generalist. So I do a variety of things, including code design, UX design, coding, financial simulation, fundraising, hiring, sometimes even like sales and marketing.
Wow, that's a bit of everything. And yeah, Rohit, what about you?
Yeah, for me, because we're in different time zones, I start my day with early morning sync on most days. So it's good to touch base, get the day started, figuring out, it's not a large team at the moment, so just quickly figuring out what the priorities are, sharing any updates from the day prior, and then we're off to the races. And then both of us like to spend some time just doing deep work, and often that means just powering through docs or powering through conversations with customers, or previously, not that long ago, was investors. But we like to have our alone time, but then also sufficient collaboration. I focus on a lot of the non-technical things and a lot of the investor conversations and a lot of the potential user conversations, talking to partners in the ecosystem. I look at that. So it's a lot more external facing. And so, yeah, there's plenty of conversations that I'm in, and there's a lot of calls that I'm in during a day, interesting time zones now and then. But overall, it's pretty fun. It's hard work, but it's a lot of fun.
Yeah, it sounds great. And yeah, congratulations for raising the 2.5 million. It must be amazing, especially you guys raised it during the bear market, right? And yeah, how was that like?
Yeah. So I can speak to that. So we started raising earlier in the year, but by the time we closed around, it was like mid-year, just as things were starting to go south. So while our last few checks were coming in, things were like starting to get pretty bad. We were lucky enough that we had about 36 investors in total, and all but one kept their commitment and did send us a check. One of them could not for market reasons, but it wasn't a big deal. It was about like a 10, 20K check. And so we were grateful that despite a turn in the market, we had our investors still continue to believe in us, continue to keep their commitment. I see Kia, he's one of them. Really glad to have him on the team. And so, yeah, it was easier when we started and got pretty hard towards the end. But overall, I think what our vision was that we're building for the longer term. And so, yeah, you will have bull markets, you'll have bear markets, but what we're building is structurally necessary. And so from a medium to long term, of course, in the short term, we're going to face a lot of the issues all protocols are facing. But I think our investors understood that from the medium to long term, we're the kind of protocol that could build a lasting solution for the long run. So we had everyone still be a part of it. And we also have, after the fundraising, we maintained our business operations in a way that accounts for the downturn, that accounts for the fact that things might not get better for a while. And so we stayed lean. We have plenty of runway still in the bank, and we're excited to go launch. But yeah, the fundraise was fun. It was a lot of fun.
Yeah, that's great. Yeah, let's go into the product a bit more. As for the credit default protection pools, how do they work?
Yeah, so I can probably talk about the initial pool that we are thinking of. So initially, we are going to work with Goldfinch. So we're going to be aggregating lending pools in Goldfinch. And then Goldfinch lenders can buy protection against their position to hedge against the default risk out of these lending pools. And if you want to provide protection for the default, you can, as a seller, deposit capital and earn interest from premium.
I see. And I guess in this case, those who put their money into the credit default protection pools to protect the investors who are willing to subscribe or pay a fee for the protection, are they taking 100% risk on their capital?
So that depends on the default probability. But when we aggregate lending pools, we ensure that the correlation between lending pools are going to be low. So the chance of all the lending pools defaulting is quite low, we think. And if you actually look at the lending pools, none of them has defaulted.
Yeah.
Even in other protocols like TrueFi, MapleFi, not all of them have defaulted, even in this extreme scenario of FTX defaulting.
Yeah, we do see that as well. Because Bluejay is also looking into the real asset lending space. I guess for Goldfinch, so far nothing has happened for them because most of their loans are from fintech credit funds borrowing to Southeast Asia and Latin America, as compared to, let's say, TrueFi and Maple, where a portion of it has gone to crypto trading institutional trading firms. But yeah, I understand you guys are aggregating a few of their lending pools together, so the risk for those who provide their capital for the protection pools is much lower. Just curious, let's say as a user, is there a minimum sum that I need to put in to be eligible for the protection pool? And can you run through like how would the process look?
Yeah, so as a seller, you mean as a seller, right?
Yeah, correct.
Yeah, there's no minimum amount. However, we have the leverage ratio in our pool, which is the total amount of capital divided by total protection amount. And this leverage ratio has the floor and the ceiling. And when you deposit, your deposited amount should not exceed these leverage ratio limitation. So only when you exceed the limitation, you cannot make a deposit. But in terms of like time constraint, you can deposit anytime you want.
Okay, understood. And yeah, for you guys, what profile of consumers are you guys targeting for such a product? Who do you see are willing to provide their capital for the protection pools? And are you expecting more institutions or retail investors?
Yeah, so I can take that one. So we have two sides of the marketplace, right? We have buyers and sellers. Buyers are those who are existing lenders into some of these protocols. And so naturally, the makeup of users who are lenders into these protocols will determine our initial market. And so we're starting with Goldfinch, which is just the first of many protocols we'll be partnering with. And so if you look at a Goldfinch, currently a lot of their user base tends to be high-end retail. There are these whales out there that have significant investment in Goldfinch lending pools. And so those tend to be our primary target. There are institutions out there as well, and then also general retail. But that's where we're seeing the most traction. Then that's because that's what Goldfinch, that's the makeup of Goldfinch's user base at the moment. And so that could change from as we go from one protocol to another based on what that protocol focuses on. But that's where we're starting off, is the whale and high-end retail market on the buyer side. On the seller side, we're actually seeing a range of different investors, primarily three types of investors who are most interested in what Carapace is doing. So the first one is institutions, so they're asset management firms, it's hedge funds who have credit teams, who have some experience in the under-collateralized lending space or DeFi as a whole. And so those teams are interested in working with us. There's also VC firms who are interested in picking up a token, because as part of an initial pool, like a lot of projects, we're offering tokens. And so they're interested in what we're doing from a structural perspective and want to come in. And then the third, we're also seeing retail, both the higher end like whales, but also like general retail interested with coming in with smaller amounts. That's what we're seeing, like a pretty wide range of users who will be part of the protocol. But if you had to ask me, personally speaking, I think where we're going to get the most traction is from institutions to start with. And then over time, as people get more familiar with what we're doing, get more familiar with other protocols that we're working with, we'll start to see a lot more retail participation. Hopefully, we start seeing overall more enthusiasm in the retail segment that has gone away in the last few months. And so that's how we see things shaping up. And I think one of your questions earlier was, is there a minimum amount? No, we won't have a minimum amount, at least initially. And so anyone with wallet and some amount of USDC can come in and start being part of the initial pool.
Yeah, that's lovely. Because I guess most of these collateralized loans, they require people to be KYC or be an institution. And yeah, for once within this ecosystem, retail investors of any size can participate, and that's great. And yeah, you guys operate. Yeah, are you guys exploring any other verticals beyond under collateralized lending, called like Goldfinch? Yeah.
Yeah, we're gonna be. So we are in touch with other under collateralized lending protocols, TrueFi, Maple, Clearpool. So our plan is to expand to other protocols as well. And on top of that, we are also thinking about expand to other kinds of credit risks. So right now we are focusing on credit default risk in under collateralized lending protocols, but we can, for example, provide protection to the interest rate downward volatility, for example.
Okay. I understand. That's cool. And yeah, for you guys, since you guys are working with under collateralized lending protocols in crypto, yeah, what are your thoughts on that? And do you guys see real world assets coming on chain as a growing sector?
Yeah, I can start with that. Feel free to chime in. So my take, and this kind of relates to some of the stuff you were talking about earlier, is that for DeFi to become as big as we want it to become, or we believe it can become, it will need to transfer into the real world. We talk about crypto, and there's a lot of people on Twitter crypto, but really, if you look at the world's population, what percentage of that even have a wallet, right? So it's quite small, and so you'll need for blockchain technology to find better use cases in the real world. And so to that extent, under collateralized lending is one of those arrows that helps get us there. And so extremely bullish on the under collateralized lending space as a whole. And I already made the point earlier that a lot of these other primitives need to come together as well. And I believe it will happen over time. I do think this is a more efficient, at least I can speak to lending, is like lending and borrowing is a much more efficient way to do lending and borrowing, especially in countries where it's harder to move money in and out, especially where it's harder to gauge credit. And there's a lot of innovation I see coming to the space, even as what we're doing. And I'll just mention like a couple of examples. There's folks like Fedora and Cred that's very focused on bringing on-chain credit scoring to the space, having a new way of thinking through credit after S&P and Moody's, and a lot of people in the real world have like lost trust in that. And so can we devise a better system to assess credit risk? There's also interesting protocols and interesting work being done on bringing more transparency, more data transparency to under collateralized lending, because a lot of folks in the ecosystem have said, hey, the data we have is good, but we need more. There's more out there in the traditional finance world. And so I see some of that coming through as well, and improvements in that area. And so I see 2023 as being a place where we consolidate. There's been 2 years of great growth, a bit of stabilization after what happened late last year. But I think this is the year in which people get more mature, protocols get more mature, and we start building for the longer run. That's my take on the space as a whole. Ty, feel free to chime in.
Yeah, from the first principle, I think under-collateralized lending protocols make a lot of sense because yields are higher for lenders and it's more capital efficient for borrowers. So yeah, I do believe these protocols are going to grow pretty big.
Nice. And yeah, to also share a bit on what Bluejay thinks, DeFi use have really came down due to the reduction in lending and borrowing on chain for trading. Yeah, due to the currently, it's more like a prolonged bear. And yeah, the only way for higher use to come on and for a more circular, circular money system, we must bring in real world assets where actually the assets are actually generating revenue and hence are able to pay the higher interest rates. And yeah, it really helps solve for credit scoring and especially for emerging markets where it might not be accessible to all SMEs. And yeah, that's the reason why fintech credit funds exist there. And those companies need capital, and companies like Goldfinch are able to provide it through crypto investors, and that's great. And yeah, I guess for the main issue with real asset lending is the centralization risk that it poses, because at the end of the day we still need to trust that there's collateral off chain that can back the loan. And yeah, what do you guys think about that, and how does Carapace partially solve for it?
You mean how a protocol is going to minimize the centralization
Yeah, if it
in your own
does,
system? Or
yeah. I guess first part of the question is like, what do you guys think of the centralization risk that asset lending poses due to the fact that most of the collateral is off chain, and does Carapace play a part to solve any of this?
yeah, every time you try to move off-chain data or assets or anything on chain, there's a risk of centralization, right? So you need to have a good way of validating the data or the assets. So in the world of under-collateralized protocols, I think we definitely need to bring more transparency to the collateral and balance sheet of the borrowers. And under-collateralized protocols and a protocol like Crypto have been working on this, and I think it's quite important. I think Vitalik also wrote the blog post about a proof of reserve. So maybe there's something that cryptography can do there as well.
Yeah, okay. And Rohit, do you have any thoughts on the centralization risk that real asset lending poses?
Yeah, so adjacent to what Ty was saying, I am interested. I haven't seen any kind of developments per se, but this is more specific to our space. I'm interested in seeing if ZK technology can play a role in helping more data transparency and effectively not having one point of control. You have some mechanism where you're able to, without borrowers sharing all their data, they're able to indicate, maybe in certain thresholds that they're able to meet or certain standards they're able to meet, help convey this information to other participants without giving up their information or without trusting any one party, with not misusing that information. And so I'm very interested to see potential solutions coming there, but that's more an idea in my head right now. I haven't seen any protocols building it. If there are, please let us know. I'd love to figure out a way to work with them, but I think something in that space will emerge this year, and that's something I'm looking out for this year.
Yeah, nice. And yeah, to round it up before we open the question to the floor, what for Carapace, what's the roadmap for the year of 2023? What do developments look like down the year?
2023.
Yeah, 2023 this year.
Yeah. So we're looking to launch in production in 1 or 2 months. And then after that, we have a plan to upgrade our protocol. So for example, it's not fixed yet, but we're going to probably be aggregating more protocols. Plus, we also are thinking about introducing a tranche system, a protection pool, where a junior tranche is the first loss capital with higher yields, and a senior tranche is the second loss capital with the lower yield.
Okay. Yeah, that's good to know. And yeah, for I guess the two of you, that's more or less it for us. But yeah, actually, Bluejay ourselves, we're also interested in getting into the real asset lending space, but providing, I guess, different loan types to come on chain. Yeah, in our case, probably towards small and medium enterprises in the Southeast Asia region as well. And looking forward to what you guys are going to launch soon. And for those of you here, if you guys haven't, kindly go over to their website and you can register for your... Actually, on their website, they can register for early access, is it? Or provide their emails for newsletters? Is there anything like that?
Yeah, so you can sign up for our waitlist and we'll share the test version of the protocol. And as we get closer to launch, we keep sharing updates with those users as well. So all users need to do is go to our website, sign up for the waitlist, and we keep giving updates via email. And then over time, over Telegram and Discord as well. There's also a Discord channel which users can join. So that's the two best ways to stay in touch with what we're doing.
Yeah, also follow our Twitter.
Of course.
Yeah.
Yeah, so I guess, thanks a lot for that. And to the floor, anyone has any questions for Carapace, Ty, and Rohit, the co-founders? If you do, kindly just request to speak. Or if you're shy, you can send us a tweet.
Yeah, while we're waiting for those questions, I had a question for you. When Bluejay is thinking about bringing more financial access to SMEs in Asia, I think that's what you mentioned. Are you guys thinking about accessing some of these under-collateralized lending pools, or do you think you might put together some of these pools in the future? I'm curious to know how you guys are assessing it and what your path is.
When you say put together, do you mean aggregate a bunch of loans so that the risk... Oh, okay. Actually, on that, I have no clarity at the moment. I just know I'm more on the marketing side. The BD is carrying out the job of bringing on those loans. And with regards to the product development, it's still on the way. We'll be launching around mid-March. But and all this is privileged information because, actually we haven't done much marketing on it either. But that's one way which we see, I guess, for us, we are a stablecoin protocol for Southeast Asia. Currently, Blue SGD, and we'll be doing more towards Philippines and Indonesia. And we see that as a key way to build out for the stablecoin as we can provide higher use for the stablecoin lending products like these.
Got it. Makes sense.
And we have Cookies here. If you don't mind, introduce yourself and ask your question.
Hi guys, are you guys able to hear me?
Yep.
Okay, nice. So thanks guys for the Twitter space. I'm Cookies. So I'm a venture analyst at Octava Digital Assets. So we are a multi-strategy fund based here in Singapore. So I was just curious about the risk that the sellers actually take on. So I just wanted to ask, how much capital do they have to put when they are selling the protection?
Yeah, just to clarify, thanks, Cookies. Just to clarify, you mean what's the minimum you have to put, or are you saying like how much are we letting into the pool for the initial?
How much do they have to put? Because they are essentially like the backup, right? Should any of the borrowers default, and they will be the ones that would have to return the capital to the lenders.
Got it. Yeah, go Ty. Yeah, go ahead.
Yeah. So imagine that $100 worth of protection is bought. And what you hear when I mentioned the leverage ratio, we have this thing called leverage ratio. And the leverage ratio is the total capital provided by sellers divided by total protection bought. So if the total protection bought is $100 and then the total capital provided is $50, then the 50% is basically is going to be the leverage. And initially, we set up the leverage ratio floor as 50% and the ceiling as 100%. So the capital for $100 worth of protection, the capital from sellers should always be in between $50 to $100. And this is based on our analysis that not all the loans are going to default. Does that make sense?
Yeah, that makes sense. If I understand this correctly, if let's say a buyer buys $100 worth of protection for perhaps say a loan that is worth $2,000, in the case of the default of the $2,000, how much will they be able to receive back?
So if you buy protection for $200, then you can get $200 worth of protection. Or did you say 2,000? If it's 2,000, it's 2,000. So you can choose the duration of your protection and the amount of protection.
Oh, okay. I see.
Yeah.
Okay, got it. Thank you. Thanks, guys.
Yeah, that's a good question. And yeah, if anyone else here has any questions, kindly request to speak. We'll give you a minute. And yeah, thanks again, Rohit and Ty, for joining us for Twitter Spaces. Yeah, you guys are probably doing more of these, right? As you guys move towards launch. Yeah, it's great.
Yeah, we have one coming up with Goldfinch, and we also might do another one with a few of our friends in the space. So yeah, a couple more coming up in Feb. And at some point, we'd love to do one more with you guys in the future as well. Thank you for hosting us.
Yeah, thanks a lot for that. And yeah, probably when we launch our LAMP product, so there'll be more synergies as well, and more for us to talk about. Yeah.
Awesome. Looking forward to it.
And yeah, Ty, you got anything to say?
No, follow our Twitter, join our Discord, try out our test product. Yeah.
Okay. Yeah.
And yeah,
If I can, I'll recommend you guys to use Galaxy for your Twitter Spaces in the future as well. It allows you to issue like on-chain achievement token for listeners, so they can receive an NFT when they listen to the Twitter Spaces for a certain duration. And yeah, that helps to bring on more people as well. Sorry I didn't put it on today because I have some restrictions. That's just a recommendation.
Got it. Cool.
Yeah.
cool.
Yeah, that's about it for us today. Thank you again, Rohit and Ty. And glad to be learning more about Carapace before launch, and also to have a sneak peek into what you guys will be building for 2023. And yeah, really can't wait for that.
Yeah. Last thing, just want to shout out to my co-founder. He just got off like a 14-hour flight or something. And still, so thank you.
My God, Spaces, you really shouldn't have.
No, this was literally my first Twitter space I wanted to join.
Okay.
Thanks.
Your first
for hosting.
ever Twitter Spaces.
Yeah.
Yeah.
Oh damn. Okay. But yeah, you should please get more rest.
Cool.
Yeah. Okay. Yeah. If not, yeah, that's about it. Take care, Rohit. Take care, Ty.
All right. Take care. See you guys.
Yeah. Take care. Bye. Thank you.
Okay. Bye.